Okay, welcome all to this presentation by NORBIT. Q4 results is a splendid quarter delivered and an upbeat guidance for 2023. So with that, I think I just leave the floor to the CEO, and he can take us through what we can expect.
Thank you, Kenneth. So I'll give you some update on the Q4 and the full year for 2022 for NORBIT. So as you can see, the numbers we presented today is a record when it comes to revenues for the quarter. It's up 40% from the same quarter in the previous year. The EBITDA ended at 67 million NOK, representing 19% EBITDA margin. The good thing in this quarter is that all segments has continued to contribute to the growth. You see from the chart that the quarterly fluctuation is part of the nature of the company, so this is expected also going forward. Looking in the full year 2022 numbers, we see we are on a good path towards the announced 2024 target. So it's satisfying to report 48% revenue growth year-over-year, and the margin is lifted to 20% EBITDA margin. If we look from 2018 until 2022, this is the period from so NORBIT did the IPO and became stock listed in June 2019. We had a long-term financial target in the IPO process, where we said we're targeting a CAGR of 25% with an EBITDA margin of 20%. So we're well on that, and we'll get back to our target going forward. So it's satisfying also that the earnings per share is more than doubled since last year. So we've delivered 1.82 Norwegian kroner in last year. And our eminent board of directors has proposed a dividend of 0.7 NOK per share. So I'll give you some flavor on the different segments. So in the Ocean segment, it's been very good sales on sonar, and this has given a total revenue in the quarter on 127 million NOK, with an EBITDA margin of 32%. We see for the full year 443 million NOK, which is an increase of 17% from the year before. The EBITDA margin is 33% for the full year in Oceans. So to give you some more insight what's underneath this and what's behind the numbers, we have a split showing here that our sonar sales is a very big portion of the revenues in the segment. So the Winghead sonar is the newest family, and this has grown from 71 to 122 million NOK, whereas the old family, the VBMS platform, is on a similar level as the year before. So, but what this shows is that our strategy of broadening the product offering is really what is fueling the growth. We have a very, very good global platform for sales. The distribution is working. It's able to sell new products, new innovations. So our investments in broadening the product offering is really the key behind this growth. Connectivity, it's been quite stable revenues the last 3 quarters. slightly north of 80 million NOK. The margin is lifted to the 30% EBITDA margin. So for the full year in Connectivity, we have 308 million NOK in revenues. It's approximately a doubling from the year before, and an EBITDA margin of 25% compared to 16%. It's been asked before if we could give some split on this, and they share this. So you see that the base in this is onboard units. It's road tolling devices. We have had a strategy of migrating that business from public tenders to business partnership with long-term key clients, and this has been quite successful. So this has grown from around 50 million NOK to 136 in 2022, and the margins in this segment, this sub-segment, has been improving a lot. On top of this, we have enforcement modules for tachographs, representing 37 million NOK, and we have modules for enforcement on satellite-based tolling representing 48. The subscription and e-toll being represented as we did the acquisition back in August 2021 of a company in Hungary, where we have a fleet of 45,000 vehicles being tracked towards 4,500 clients. It's a high percentage of recurring revenue. It's a subscription-based business model. So this yields for 77 million NOK last year. Mention our strategy of really through partnering with some key customers to have business-to-business relation on onboard units. It was a nice pickup last year, and this year has started very, very well, where we announced early in January that we've received an order from a European client for delivery of these products for 150 million NOK first half. So Connectivity is on a good pace. Product innovation and realization, it's been very, very good improvement or growth in revenues. Part of that is explained by customer reimbursement for higher material costs, so we'll get back to that. But despite of that also, it's been a very good growth. It's a record quarter. For the full year, we've booked 457 million NOK in revenues, which is an increase of 57%, and with an EBITDA margin of 10%. The split in this segment, so the main elements in this is, so as I've spoken about before, so NORBIT's total manufacturing capacity, we're utilizing approximately 50% to make our own products. The remaining 50% we offer on contract manufacturing terms out in the open market. This has a strategic importance for us to ensure that our in-house manufacturing capabilities are sharp, also manufacturing our own products. So the main part is the contract manufacturing, which yields for 256 million NOK. And then on top of that, we have R&D services and some customized products we're offering to some key industrial clients, yielding 94 million NOK. On top of that, we have this customer reimbursement which is extraordinary, and this passes through without any margin. But if you adjust for that, it's still a very satisfying growth also in this segment. With that, I'll leave the floor to Per Kristian to give us some details on the financial figures.
Thank you, Per Jørgen. I will spend some minutes walking you through the financial highlights of the quarter. Revenues in the fourth quarter amounted to 347.3 million, representing an increase of 40% from the corresponding period of last year. All three business segments reported solid growth rates. For 2022, revenues were close to 1.2 billion, up 48% from 2021 and exceeding the guidance provided. EBITDA for the quarter was 66.5 million compared to 41.5 million in the fourth quarter of 2021. This represents a margin of 19% compared to 17% in the same period of last year. The improvement in the results is primarily driven by increased revenues in all segments, lower operating expenses, but partly offset by an increase in payroll expenses as we continue to scale the organization to prepare for further growth and to pursue strategic initiatives. Operating profit was 42.6 million, while net finance expenses was negative 8.9 million. Of that number, 5.4 million relates to net interest expenses. Taxes was positive 6.1 million due to recognition of a deferred tax asset in the quarter. Net income for the period was 39.8 million. In the fourth quarter, all three segments delivered result improvement compared to the corresponding period of last year. Segment Oceans reported 9% growth and stable gross margins. The increased gross profit was, however, partly offset by an increasing cost base due to continuing strengthening of the organization as we pursue the strategic initiatives mentioned to grow Oceans even further. The EBITDA in the quarter increased to 40.6 million. In Connectivity, revenues increased 25%, primarily driven by strong demand for DSRC products, while operating expenses were 3.8 million lower than in the fourth quarter of 2021. This resulted in an EBITDA for the quarter of 23.9 million. Segment P almost doubled revenues in the quarter to 150.2 million, driven partly by strong demand for contract manufacturing. As in prior quarters, a fair share of the revenue generation was customer reimbursements for extraordinary material costs where we have no margin. Adjusted for this, revenue growth was still 79% from the corresponding quarter of 2021, and as a result of the higher revenue base, gross profit increased 14.1 million year-over-year. Partly offsetting this was a 3.3 million increase in operating expenses as payroll expenses rose. For the quarter, PIR ended with an EBITDA result of 13.3 million. Next, balance sheet and our financial position. Property, plant, and equipment increased 25.3 million in the quarter, primarily due to an increase in rights of use assets as we lease financed the purchase of 2 production lines to increase the capacity at our manufacturing sites in Norway. Intangible assets stood at 258.8 million, on par with prior quarter. Inventories decreased 4.4 million in the quarter, while trade receivables increased 61.1 million, and is explained by the higher revenue generation quarter-over-quarter, as well as revenue being more skewed towards the back end of the fourth quarter. Trade payables was 132.6 million at the end of the quarter, down from 151.4 million at the end of the third quarter. Net interest-bearing debt stood at 295.6 million at the end of December, an increase from 276.8 million at the end of September. Our equity ratio was 59% at quarter end. In the quarter, our net interest-bearing debt to EBITDA ratio remained at 1.4 times. Heading into 2023, we expect the ratio to decline throughout the year due to expectations of improved results and free cash flow generation. We remain firm to our capital allocation framework, where we prioritize to maintain a strong balance sheet and liquidity buffer to support our organic growth ambitions, requiring investments in R&D, working capital, and machinery and equipment. In the fourth quarter, we strengthened our liquidity position further and established a new term loan and refinanced our overdraft facility. In total, this provided us with 220 million in additional liquidity, bringing the available funds under the credit facilities to 439.4 million at the end of the quarter. In the fourth quarter, our net working capital ratio was 29%. As we have stated before, our target level is to be between 25% and 30%. Over the last 18 months, the challenging environment for components has put pressure on our capital efficiency, primarily due to lower inventory turnover, as we have purchased longer series of components to safeguard deliveries. There are, however, some signs of improvement in the supply chain for raw material components, but for certain semiconductor components, the market is still challenging. Lead times remain elevated and remain unreliable. Heading into 2023, we will work actively to improve our capital efficiency to strengthen the free cash flow. Our ambition is over time to reduce the working capital ratio down towards 25%, assuming a normalization of the supply environment. Lastly, the cash flow for the quarter. Cash flow from operations was 7 million, explained by an EBITDA of 66.5 million, a net increase in the net working capital of 42.2 million, and 8.9 million in net finance expenses, and finally 8.4 million in taxes paid. We invested 27.2 million in the quarter, primarily explained by 11.8 million in R&D investments, 10.8 in investments in machinery and equipment, and 7.8 million in net cash outflow relating to the acquisition of Aursund Maskinering, a long-standing supplier for our sonar production. For 2022, our total investments in R&D were 60.5 million, while investments in machinery and equipment were 31.5 million, excluding 27.2 million in lease-financed machinery. For 2023, we expect to invest between 60 and 70 million in R&D, primarily allocating capital to the Oceans and Connectivity segments for new product innovations. Investments in fixed assets are expected to be between 35 and 45 million, primarily related to expansion of our production capacity at the Røros site. Cash inflow from financing activities was 31.4 million, primarily explained by 25.8 million in net change in borrowing and leases, and 5.6 million in a seller's credit issued in relation to the mentioned acquisition of Aursund Maskinering. I will give the floor back to Per Jørgen, who will take you through the outlook section.
Thank you. Looking into the future, it's with pleasure that I can say that we have a target for 2023 of delivering revenues above 1.4 billion Norwegian kroner. And that shows that we aim to take further steps towards our 2024 ambition of 1.5 billion. When it comes to margins, we expect the margins to improve compared to this year, and we aim to deliver better margins so that we also on the margin side take steps towards the 2024 ambition, where the ambition is to deliver more than 25% EBITDA margin. Looking into the segments, so this year has started out very, very well. In the oceans, we see high activity in the first quarter. And I'll remind you that historically, the first quarter is low season for this segment. Despite that, we see a very strong start of the year, and we target to deliver growth compared to the corresponding period of 2022. In connectivity, as mentioned, we have this recently announced contracts for onboard units to be for 150 million NOK to be delivered towards one customer in the first half of this year. And we're continuing the discussions for the volumes for the second half. With this and all the other business in connectivity, we expect to report revenues between 270 and 300 million NOK in the first half of 2023. In PIR, we see that the trend of this, the interest from the market to have products made in Europe remains strong. And we expect that this will continue for 2023. So the first quarter, we expect to report revenues higher than we had in the corresponding quarter. So all in all, we see a very strong start. We see good drivers for all segments and are very positive for the outlook of the company, both in short term and long term. So.
Okay. With that, we move on to the Q&A session. So if you have any questions, please post it online. I have received a few here already, so I will address them shortly. But do the easiest thing first. I'll start by myself. So if you start on ocean, it's thank for the split here on the revenue side. But given the macro outlook and also increasing tension globally, how do that impact your demand on the sonar side in security and offshore wind and so on? I guess it's require a lot of sonar.
So we see a very strong demand, especially in the renewable segment, so offshore wind, as you mentioned, where that's part of the when we say that it started very well already in this quarter. That's one of the drivers for that is the renewable, where we see that our clients offering surveying of fields where you will install this offshore wind farms, make use of our tailored sonars for that. When it comes to the security surveillance sector, so underwater surveillance is also very hot. What you see from you start working with the lead until that materializes into a purchase order is a slightly longer lead time, since longer process time. But the lead pipe is very interesting.
On the split also here, it seems like the wing head is moving at a rapid speed on demand side. But on the older one, you still have a significant demand there. But if you look into 23, how do you think the mix will it be the same as you saw this year?
Yeah, so when we look into the VBMS part of the sonars, we see that it's in some regions there is still good growth, whereas other regions has been more flat. So we expect that we will be able to continue to grow also on the VBMS. Probably not as much as we aim for on the winghead, but our target for this year is also to continue to grow the VBMS.
Just to explain us the short what's the difference between the winghead? What's the main benefits here compared to?
So they're addressing slightly different markets. So So the winghead sonar is a more high-resolution sonar that could be very suited for very accurate inspection of valuable assets underwater, etc. Whereas the winghead approaches a more classical surveying bathymetric market. So it's slightly different market segments, and also on the winghead we have a stronger platform where we easier can tailor new user features to continue to open up the market for new applications and new users.
Okay, thank you. Moving on to connectivity here, it's growing significantly here. And also here, thank you for the split here. But could you share some comments around the mix on the margin side on within each different components here?
Yeah. So maybe you'd like to...
Just a broad comment.
Yeah.
I mean, broadly speaking, given our strategy to migrate more of the OBU business into the B2B segment, I would say that the margins there are quite similar, actually. So there's not a lot of difference anymore between the margins. In the past, there were substantially much lower gross margins on the OBUs because there was a completely different market for the products. And in that case, we operated in primarily and mainly in Norway, where the tendering process was quite different, and price was the first and foremost criteria for purchasing the OBUs. Now we've sort of tried to innovate us to the insurance industry and had a strategy of that which has been, as Per Jørgen said, successful.
And I think maybe it's fair to add to that working in a business-to-business relation, we can, in addition to work on the technology and also to innovate, to have the world's best microwave circuitry, low-power devices, we can also do things on logistics, etc., which makes life easier for our customers, so that we can have more added value in the value chain. So I think we have some advantages for that working closely together with the customer, we can reduce a lot of cost and we can simplify life, which has a value and they're willing to pay for.
And on the insurance side, there you have attracted some interest from, at least reportedly, some interest from insurance side. So just the link here, if you can share some comments around this one.
So we see that in several countries in Europe, the insurance actors are entering the scene on toll collection, as in Norway, where it's now the insurance companies setting up subsidiaries, taking care of the tag issuing service and collecting the tolls. And it's a trend, and we're following very closely. So there is other European countries also in the same position as in Norway, and we follow very carefully that we expect that maybe this could be relevant in even more European countries. So I think a significant portion of the revenues we show is European customers here now. So it's very interesting right now.
But it's right to understand this, that it's just in its starting point right now here, and it's quite early days compared to adoption for broader adoption.
I would say it has really started. It's really running on a good scale.
So moving on to the peer segment here. So also here is a quite significant volumes. You indicate 50-50 between internal and existing external clients. Could you indicate some kind of level of utilization right now, or?
Yeah, so I think we're running our factories right now on 2 shifts. So there is still some headroom. We're doing some add-on investments in machinery so that we could continue to do even more on 2 shifts and not necessarily stepping up to the 3rd shift in the factory to have that as a security valve going forward.
And that brings me over to the guidance. I think we have more guidance currently indicated that growth on a revenue basis more than 20% from the 22 level to 23. So, but looking into the guidance on connectivity, the first half seems extremely positive, close to 70% year-on-year growth. So that's I guess what I'm looking into here is that the confidence you are expecting above 1.3 billion here, or 1.4, sorry. So, but it seems at least first half will be a tremendous growth rate.
Yeah, and I think this is also what's the beauty of transferring the business model from this public tendering to more business to business, more long term, where you could do better planning together with the customer. In the public tendering, you could win a tender and then you have to deliver within a certain time frame, and then it's nothing. So that's to plan and have more leveled. So I think the visibility in the connectivity segment is at the best right now. So.
Okay, perfect. Thank you. And we have received a few questions here online. So first of all, if you can provide an update on the component market within each business segment, how it's affecting each business.
I think the challenge is very different. So in the connectivity segment, that's very high volumes. So securing material for this high volume manufacturing, it's quite different from in the ocean segment, where we do hundreds of sonars, and in the connectivity segments we do several hundred thousands and millions. So that's very different. So we have tailored security strategies, supply chain strategies for the different segments. And as Kristian mentioned in the presentation, we see that the component market has signs of improving. It's still challenging. So we continue on our strategy to have security stocks to ensure that we can deliver. But we also see that with some more improvement, there would be room to scale down some of the security stock and reduce some inventory.
So on that note, on the working capital, you mentioned that the target, long-term target, should that be within reach within 23, or is it more 24 potential here?
I guess that heavily depends. I guess the answer to that question heavily depends on how the component market will develop during 2023. And as we say, in some parts of the value chain, it's been improved, but there are still quite expensive critical components that have very long lead time still.
And they're unreliable, which is the challenge.
Yeah.
Okay.
Yeah.
So I don't think you will expect to see a major improvement in the capital efficiency in 2023, but we will certainly work very closely of improving that ratio and improve the inventory management so that we are able to increase the efficiency.
Okay, moving on to the question here. How much growth can you handle within the current production facilities? Can you shift or restrain volume from the contract manufacturing to own production? That's
Yeah, so I think that's part of what's good in this strategy, also giving this flexibility. And I think when you look on these orders we've announced recently, stepping up, it simplifies life to have your own in-house manufacturing to do that. Because we can really do strategic planning in a different way than relying on external capacities to do this manufacturing. I think our scalability is good. We need to do some additional investments to be prepared for further growth. But it's not any major investments needed to continue and take the growth.
Okay. And staying on the growth side, demand for environmental monitoring in the quarter and 22 was lower than in 21. So any particular reason here?
Yeah, so at least the booked revenues is lower. I think the demand is fairly good, but the decision time in this sub-segment is a little bit harder to predict. So there is a very interesting lead pipe, and we'll continue to ensure to get some of that on orders and then deliver.
And then we continue within ocean, and any comments around the possibility of investing in new products, new market segment, etc.?
Yeah, so we continue to do investments. We're also doing in some new sub-segments. I think the major contributor going in the near future for that would be in the security field, where we announced earlier the introduction of this guard point sonar family for underwater surveillance. We continue investments in that and have very good hopes that this should be a major contributor to the growth.
Yeah, staying on that topic. So I guess with in the world we are living today, increased security is something we should expect and anticipate going forward. And harbor within the port is important, but also out in the ocean, I guess, around pipes and on offshore wind. But any restriction on the current portfolio that you are looking at to solve or to expand the offering here?
So I think it's a lot of interesting things going on. Being part of the security market, a lot of the things we're working on would also be quite confidential, given the nature that this should be security measures. Yeah. So we've done some very good recruitments on the commercial side for that also. So you see that we've strengthened our organization with some seniors that really has very valuable domain knowledge in this field. So we think we're well positioned to really contribute solving some challenges in that part.
Okay, and staying on this segment, how long do you think you can expand the product portfolio? I guess it's a quite open question.
Yeah, that's. I mean, underneath the logo of NORBIT, it says "Explore More," and I don't see an end to it. So we'll work hard to continue to grow and be profitable as we grow.
Yeah, and on the new project you are looking into, so the internal rate of return here, requirements are here. Is there any?
I mean that obviously depends on the type of project and the risks and sort of the opportunities that we see in that. There's no general threshold for starting such an R&D project. In general, I think the overarching goal is to reduce the payback period to as low time as possible, and I think we've been fairly successful on that. A good example of that is the Winged platform, where we invested a lot of money in 2020, and I think what we see now in the slides is that we're really just start to see some value creation being made of that investment.
I think also what we really try is to balance the investments that has short return on investment, but also to have some more long-term to be positioned for the growth, not in this strategy period, but also for the years ahead of that.
I guess that's why you're the management team and we are more focused on the near term. But a similar question actually also on the R&D. So I guess the answer is not that different on the R&D side if you have any threshold here on what you are investing in on R&D.
No, I was referring to R&D, so maybe I got the question mistaken.
New product or development of sonar and other products. The first was the product side, but I guess if there are no more further questions, I'll refresh it. No, that's all I think. So congrats to another great quarter. That's from us. So we're looking forward to the future. So okay, thank you all.